recommends somewhat more conservative portfolio. Joining us now, Schwab Asset Management CEO and CIO, Omar Aguilar. Hello, Omar. Good to see you as always. So what's your assessment of the market's current thinking that we might be able to thread this needle, a resilient economy, lower rates, maybe the Fed eases next year, and perhaps we can sidestep recession for a while?
Yeah, well, what a difference, 12 months could make of what we were discussing a year ago to what we're discussing now, where, clearly the soft landing scenario seems to be the most plausible case among everything. A year ago, we were all talking about recession. We were all talking about the fact that inflation was really high and growing. We were talking about, how the labor market was so hot that was fueling significant amount of imbalances in terms of supply and demand, et cetera, et cetera. So as we think about where we are now, it's almost seeing exactly what the Fed, wanted to have. It's almost like the perfect Goldilocks scenario for what they have been working throughout the year. You see the economic, resiliency of the U.S. is still growing at above trend. They see wage growth, going down. They see inflation moving to the right place, and they see the effects of, the higher interest rates really just affecting the areas of the economy that they wanted to affect. Consumers is still doing what they're doing. Corporations and the credit market is still pretty solid. So overall, when you put the picture together, we seem to be navigating to these rolling recoveries into a more, we may avoid the recession and stay in that soft landing.
When you contrast it with the consensus of a year ago, maybe that's a little bit of a cause for concern, because the consensus last year that a recession was assured proved very much wrong. And so the market, maybe had a bit of a surprise in store for the majority. So where do you think that leaves us now with regard to whether the current conventional wisdom can bear out in 2024? And how would you invest through it?
Yes, that's a great point. I think, if you look at just performance of a day like today or the performance of November, clearly the market is anticipating probably a faster recovery what the U.S. economy and even just, overall markets may stand. Right now, the market seems to be pricing, very aggressive, Fed cuts into the beginning of 24, into the second part of 24, which seems to be a little premature, especially when, we have global central banks that still staying the case of higher for longer. And while they see the trend in inflation, the overall, imbalances and the geopolitical risks that we have seen overseas continue to be a potential risk that may change the outcomes. So while we're still in that more plausible scenario of a soft landing, and the consensus seems to be, that yes, labor market seems to be a little weaker, stay within that Goldilocks. We're going to hit the 2% target on inflation at the end of next year. Overall, our view seems to be like, we got to take these more barbell approach to stay, a little more conservative, knowing that while we may be at the end of the tightening cycle, usually takes, a few more quarters before we can get into the full recovery of the U.S. economy, and markets may be a little bit ahead of themselves.
But why the move into cyclical specifically at a time when the economy is slowing? If the positive viewpoint is on the fact that the economy is slowing and the Fed can start cutting rates, wouldn't you want to be in the tech space that benefits off the low rates and less the economically sensitive groups if the economy is downshifting?
Yeah, well, the big part of move to cyclicals is clearly just preparing for that early recovery scenario. And you see, again, days like today or November, where you started to see underappreciated assets, mostly on the cyclicals or on the small cap, starting to just, take on, a more leading role. We have seen for the most part in 2023 a significant amount of great performance for these mega cap tech names that actually will probably take, a backseat going into a full early, phase recovery on the U.S. economy. And with that in mind, you will see that, areas like materials, financials, more the traditional, more highly sensitive, sectors of the economy will probably perform better. At the same time that you see the potential for small caps and mid caps, start to just, take that. Again, it may be a little bit premature, and that's what we try to say is try to be a very conservative, but it's trying to just move the rotation slowly. This has been a very interesting cycle where things have taken probably longer than normal cycles. So it's starting to just move assets and rebalance towards the end of the year seems to be like a prudent strategy for investors.